claims are very much lagging, and this is one thing that we talk about in Scott's program all the time. Is the last thing to go up is unemployment. That was clearly what happened in some of the past recessions, certainly in the 80s and stuff. The unemployment can stick low for months before even after recession starts. So claims are very much lagging. What's really kicked in today, as you pointed out, Philly Fed, existing home sales. That number for existing home sales, the trajectory, the downward trajectory is as bad as 2008. And the Fed started tightening in 2007 based on data like this, based on widespreads. It's home sales. So that is the essence of the entire economy. And when people aren't, obviously it's completely locked up. And you can't buy, you can't sell. And since when is that good? I mean, people aren't going to Home Depot. They're not. And the thing is, existing homes, new home sales are the highest ever, but that's also a very sign of a peak.
The Federal Reserve stayed put on Wednesday, but forecast it will raise interest rates one more time this year, according to the central bank's projections released Wednesday. Projections released by the Fed showed the central bank would hike rates to a median 5.6% by the end of 2023, up from the current range between 5.25% and 5.5%. 12 Fed officials at the meeting penciled in the additional hike, while 7 opposed it. There are 2 more policy meetings left in the year. The rate-setting Federal Open Market Committee projected 2 rate cuts in 2024, which is 2 fewer than forecast in June. That would put the funds rate around 5.1%. The change to fewer projected rate cuts next year has more to do with Fed officials' optimism about economic growth than concerns about stubborn inflation, Fed Chair Jerome Powell said in a press conference. Broadly, stronger activity means we have to do more with rates, and that's what that meeting is telling you, Powell said. Mike McGlone shares his view on the Fed's Powell speech and what he thinks is going to really happen with the economy. He also shares his views on Bitcoin and what he thinks would happen to the asset class once stock market crashes.
I enjoy those narratives, and it's so important that we have discourse and we have politicians we hate, politicians we love, and we have disagreements. There's so many places in the world you can't do that, and that's the places that are really falling behind. Number one, China. But here's the key thing that when it comes to Fed, that all that matters. This is a screen from Bloomberg. It just shows the Fed's gonna, the next meeting is November, and there's 29% they're gonna hike. They're not going to hike. I don't think so, but my view, that's where it is, 29%. And the rate peaks around 5.46 in January. And then that's what you see now. The market expects rates to start declining. Now, this to me is not going to happen unless the stock market makes it, partly because inflation's too high. So to me, that's where it's going with the Fed. The Fed, I felt, was completely expected, straightforward. I think Mr. Powell is going to go down in history as part of orchestrating one of the biggest resets in lifetime, and not so much his fault, just by virtue of where he is in history. He had to cut a lot. He cut way too much, and then created way too much liquidity, and then he took it away too fast. And that's what I kind of showed in that other chart before. So to me, this is the bottom line. It's the market. This is what the market's priced for. So I enjoy when people say, oh, they're going to hike or they're going to cut. It's just like, hey, well, just tell me, here's what the market's already in. It's sort of the betting, the professional bettors already doing. And you do that with trading. But to me, it's just it's so broadcast now. It's so factual that you don't want to fight the Fed. And the bottom line is these bumps right here. They still have their finger on the tightening button. And what you're seeing today is not even leaving that one bit. We still are priced at this 546 level. That's what my point is. You've got to take that stock market down for one bridge at a time. First, take the tightening out of the system, it's still priced in, and then next to start going for easing. And to me, that easing period is after we start easing. If you look at history, maybe the stock market drops. After you start easing, I'll pull that one up a second. Maybe it bottoms about 2 years afterwards. That's how early we are, and that's why I had a show early on how expensive we are. And that's the point, is most people have traded cryptos. Cryptos came of age during a zero interest rate policy, have not realized that we've just been born and raised in a very much historical anomaly. Now, I became a teenager in the 70s during inflation. It was kind of just normal for me. But when you grow up and you see Lehman collapse, and then you see zero interest rates, and you start trading 10 years ago, you think that's normal. It's just, it's not. And that's what Jerome Powell's doing, is shifting back, and that's where the macro kicks in, and it's just getting started. So here's a simple thing I can show you a little bit, is on the S&P 500. It was right before COVID around 3,000. There's all the reason in the world it should go back to that level, and it's not a lot to say. It's not profound because it's what it always does in recessions. Our model's at 100% for recession. It was right here. It was bumping up against, it was running around 3,000, and it was the kind of key level. And there's very little reason for it not to go there. Now we've had this bounce, but it's exactly what happened in 1930. Market bottomed. It dropped 50%. It rallied 50%. Everybody thought it was over and then went back down. I think this is happening. The key difference is we didn't have a war then. We didn't have anywhere near the massive pump and liquidity that's dumping. And the Fed already started easing in 1929. They're still tightening.
Bitcoin price continues to retrace its January 2022 steps, hinting at a steep correction on the big picture. A breakdown of the $25,229 support level will confirm and kickstart a bearish outlook for Bitcoin. If bulls fail to reduce the bearish pressure, the pioneer crypto could revisit the $20,431 support level. A bullish scenario will develop if Bitcoin flips the $30,000 psychological level into a support. Mike McGlone discusses these in details, although he is more bearish than bullish.
I would look at Bitcoin as a macro money manager, and this is something I printed recently. I had to put this out. It's the most significant leading indicator in the history of mankind, bar none. And anybody wants to dispute that one with me, I'll find it. Well, which one's trading? I'd love to debate it, but it's the key thing is it's a 60, 70 vol asset. And I remember during 2000, that was really long gold and bonds and everything. I still lost 30% of my gold positions when they initially, everything hit the fan. And that's a 16 vol asset. So the best performing asset in history that came of age during a zero interest rate policy that's completely reversed, that still trades with a 60 vol. It's just logical to expect when the shit hits the fan, people hit their stop buttons, hit the stops, and the margin calls kick in, that asset is going to go down, if I'm right. And that's what I pointed out here. It's already started. So you look at the 20-week moving average, it's already started rolling over. This is just from like a week ago. I had to point that out. Bitcoin is already starting that process. It's already started rolling over. Now, it's not perfect, but the bottom line is this chart's going to take a little second. I'm kicking on it. But the number one thing that I watch in every day in all markets is the liquidity from, it's already off the charts. This is right here. And what I show you here is Fed Fund futures. This is a 13th Fed Fund future. So that basically it's a price indication of what to expect from the Fed in a year. It's the hopium of liquidity. There is no hope for risk assets to go up by the rules of economics and liquidity until at first thing it has to start going up is the market has to start seeing liquidity from here, meaning this number has to start going up. That's why I look at this every single day. One of the first things I look at is FFA, commodity CT, and we'll just see what's the Fed doing. What do we expect from the Fed? These numbers here, okay, the yields are dropping a little bit, but you got to really see these numbers start dropping, just especially a year from now, which is right here, September, October, 5%. That number's got to really drop to see the liquidity, and for that to happen, the stock market has to go down. It's a lose-lose because it's the rules of overvalued assets. They hardly ever go up until the market can at least see the whites of the eyes of liquidity coming. And that's, as Scott, I think could agree with you, it's just somewhat intentional from the Fed. They want to break that umbilical cord of every time the stock market goes down 20%, that they ease. And I'll show you a chart in that a little bit. That's just something that's over. That's changed.
Russia has temporarily banned exports of gasoline and diesel to all countries outside its circle of 4 ex-Soviet states with immediate effect in order to stabilize the domestic market, the government said on Thursday. It said the ban did not apply to fuel supplied under intergovernmental agreements to members of the Moscow-led Eurasian Economic Union, which includes Belarus, Kazakhstan, Armenia, and Kyrgyzstan. Temporary restrictions will help saturate the fuel market, which in turn will reduce prices for consumers, the government said in a statement. The Energy Ministry said the measure would prevent unauthorized gray exports of motor fuels. The ban is indefinite and further actions will depend on the saturation of the market, according to Russian First Deputy Energy Minister Pavel Sorokin. We expect that the market will feel the effect quickly enough, but then it will depend on the saturation of the market and the results, Sorokin said. Russia in recent months has suffered shortages of gasoline and diesel. Wholesale fuel prices have spiked, although retail prices are capped to try to curb them in line with official inflation. The crunch has been especially painful in some parts of Russia's southern breadbasket, where fuel is crucial for gathering a harvest. A serious crisis could be awkward for the Kremlin as a presidential election looms in March. Traders say the fuel market has been hit by factors including maintenance at oil refineries, bottlenecks on railways, and the weakness of the ruble, which incentivizes fuel exports. Russia has already cut its seaborne diesel and gas oil exports by nearly 30% to about 1.7 million metric tons in the first 20 days of September, compared to the same period in August, according to traders and LSEG data. Projections are very bearish, and it is increasingly certain that this would be the biggest recession of our lifetime. What do you think about that? Share your opinions below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.